Enron's accountants followed the rules. That was the problem.
In 1992, Enron received SEC permission to use mark-to-market accounting for its natural gas trading operations. Under mark-to-market, the anticipated future profits of long-term energy contracts could be recorded immediately when the contract was signed, not when cash was actually received. This was standard practice in banking. Applied to an energy trading company, it created an environment where projections replaced reality.
When Enron signed a 20-year contract to supply broadband services, the company's accountants calculated the net present value of anticipated future revenues and booked that figure as current income. Analysts outside Enron couldn't verify these projections because Enron didn't disclose the assumptions. The company's revenue growth looked extraordinary. It was essentially a spreadsheet.
The special purpose entities, LJM Cayman Chuco Jetty, were the second layer of the architecture. These were off-balance sheet vehicles that Enron used to hide debt and generate fictitious gains. CFO Andrew Fastow ran several of these entities personally and received approximately $30 million in fees. Internal Enron documents showed that these entities had been structured specifically to move losses off Enron's books while allowing Fastow to profit from transactions with his own employer.
Arthur Andersen, one of the Big Five accounting firms, audited Enron's books and certified them as compliant with GAAP. When the SEC investigation began, Andersen employees shredded documents, literally physically, while under investigation. The obstruction charge that resulted destroyed the firm. 85,000 employees lost their jobs because of decisions made by a relatively small number of partners.
Enron filed for bankruptcy in December 2001, at the time the largest bankruptcy in U.S. history. The documents reveal that Enron's reported revenue of $111 billion in 2000 was substantially fictional. CEO Jeff Skilling received 24 years. CFO Andrew Fastow 6 years. Founder Ken Lay was convicted but died before sentencing.
The Enron papers showed that the most sophisticated fraud often hides in the footnotes. The special purpose entities were disclosed. Technically, the mark-to-market accounting was disclosed. The problem was that the combination of these legitimate-looking structures created something that was collectively deceptive. The fraud wasn't hidden in a locked drawer. It was published in annual reports that almost nobody read carefully enough. Subscribe for the next case.